Welcome to the Canadian Investors Course, Session 2, Income Investing Continued Commentary. Please note again, slide on page 2, Terms of Use and Disclaimer, which was read in full in the introduction. We'd encourage you to read it again. Getting right on with it. What we're going to look at here in this commentary is the bond market and the potential danger of it. That we're going to investigate the question, is it really different this time? We emphasize that you should understand what you own. Don't become a pie chart victim, and we'll introduce the idea of rate reset preferred shares or talk about them. So, the bond market potential danger. It's a great advantage of bonds is price predictability. And it's really all about math. So, for example, if you buy a $100,000 10-year bond with a $100 coupon, for $100 with a coupon or interest rate of 3%, let's remind ourselves what happens if the bond price, if interest rates go up or down. So, in other words, they go up 1% to 2%, or they go down 1% to 2%, and they go up 1% to 4%. So, at 2%, interest rates have gone down a point, the $100,000 bond can be sold for $109,000 and change. At 4%, the bond can be sold for $91,000 and change. So let's not worry about the rounding error. The point is, interest rates go down, bond price goes up. Interest rates go up, bond price goes down. The gains and losses in this scenario can be greater for long-term bonds. So we were looking at a 10-year bond. If this were a 20 or 30-year bond, these results would be magnified. So is it really different this time? Well, you have to remember that whenever anybody says it's different this time, your ears should prick up and you should start to be concerned. The 2008 to 2009 global financial crisis left a huge overhang of unusually low interest rates. Huge capital gains were earned since 2008 as a result. So where do we go from here? And the big question is, would you buy longer maturity bonds now? Let's look at the math. Government bond yields today in August 2016. So we're picking August 2016 and calling that today. 5-year Government of Canada, 0.58% today. Rate was 4% January 2008. 10-year, 1.05 today. Again, 4.8% in January 2008. A 20-year, 1.62 today. Rate was 4.25 in January 2008. And a 30-year, 2.18, 4.75 in 2008. If you own 30-year bonds over that period of time, you made a pile of money. The question is, where do you go from here? So if you bought a $100,000 30-year bond in 2008, this bond would be sold for $156,370 today, and that doesn't include the interest you received. So you don't have to have much of an imagination to figure out how bond funds performed. If a 30-year bond went up by $56,000, a $100,000 30-year bond went up by $56,000, clearly the bond funds did very, very well over that period of time. So let's look at the BMO bond fund. It's a typical one you might have bought from a bank. So the chart indicates exactly what we just said. Not surprising at all. But the question is, where can this fund go from here? Look at the BMO bond fund, and you'll notice that every time interest rates fell, the bond fund improved in value because the bonds went up in price. It's common sense. Bond, in fact, I pulled it right back up on the screen again, slide 9. Notice where that's at. Let's go back to the preferred shares. Preferred shares are a form of corporate debt. They're not common stock. They're issued at a $25 value when they come onto the market, and they have a set quarterly dividend for 5 years, after which one of two things will occur. The issuing company can buy back your preferred shares for $25, in which case you get to keep your interest, you get your principal back, and you could do something else with it. Or the company, the issuer has the right to reset the dividend rate. Now, the rate at which the dividend will be reset is defined when the preferred share was set out. So, and it's based on the 5-year Government of Canada rate. So, as an example, a major Canadian bank can issue a rate reset preferred on a given date for $25. Let's say the yield was 5% per year guaranteed by the bank for 5 years. After that initial 5-year period, the bank could buy back the shares from you for $25, or you would receive the reset premium plus the 5-year Canada bond rate at that time. So in this case, if the reset premium was 4.5% and the 5-year Government of Canada bond rate at that would be added to the 5-year Canada bond rate, and let's say that 5-year bond rate was 2%, that would mean 4.5 plus 2 is 6.5%. That would be your new yield for the next period of time. So if what you're looking for is income, if you're going to start by receiving whatever the issuing yield was, in this case 5% for 5 years, you know that you're going to get your 5% for that period of time. Then afterwards, you know you're going to either get your money back or it's going to be reset at whatever the current rate is in relation to the 5-year Canada bond rate plus the reset premium. So if you're an income investor, it's a nice way to have a reliable income for a going period of time. And you can see that if interest rates go up, you're going to benefit. So it provides you a little inflation protection. Also, don't forget that since it's a dividend, the dividend tax credit applies, and therefore it's tax efficient income in a non-registered account. So you end up with a good quality investment with a P2 rating and more than double the income you'd get from a 5-year GIC, with protection from rising interest rates, at least to a degree. Anyway, it's an idea. If you want to talk about preferred shares a little bit more, this is maybe a good time to look at the postal code indicator on the website, find a trusted wealth professional if your advisor can't help you with these types of things, and talk about rate reset preferreds and figure out whether they're right for you. That's the end of the commentary for session 2. Thank you for listening.